In this tutorial, we cover specific revenue recognition applications and we start with long-term contracts. Long-term contract is one that spans a number of accounting periods. For example, a construction contract where a bridge or a building is constructed over a number of years, that is accounting periods. Such long-term contracts raise issues in determining when the earning process has been completed and the revenue recognition should occur. And then how should a company apportion the revenue earned under a long-term contract to each of the accounting period? One of the method is the percentage of completion method. When the outcome of a contract can be measured reliably, revenue and expenses should be recognized in reference to the stage of completion. Under the percentage of completion method, revenue is recognized based on the stage of completion of a transaction or a contract and is thus recognized when the services are rendered. Construction contracts are examples of contracts that may span a number of accounting periods and that may use the percentage of completion method. Under the percentage of completion method, in each accounting period, the company estimates what percentage of contract is complete and then reports that percentage of the total contract revenue in its income statement. Contract costs for the period are expensed against the revenue. Therefore, net income or profit is reported each year as work is performed. In the example here, we have the network construction project with a bid price of $5 million and an estimated cost to complete of $4 million. In the first year, the cost incurred are $3 million and this is assumed to mirror the percentage complete of the project. So the question arises is how much a company that is completing this project should report in revenue from the project for this year and how much should be the cost of the revenue. In the second year, the job is complete with the remaining cost of $1 million incurred. So how much the company should report in revenue and how much the company should report in costs. For each year, the company should calculate the percentage of the project that is complete. So for example, in the first year, the company incurred $3 million in cost, which is 75% of the total estimated cost. That is 3 million divided by 4 million, and this gives us 75% completion of the project, which means that out of the total bid price of 5 million, the company should report 75%, that is 303.75 million in the first year as revenue, and the cost for the first year will be 3 million. So the profit from the project for the year will be 750,000 in the first year. In the second year, the project is 100% complete, so the remaining 25% of the project revenue will be calculated and that will be recorded as revenue for that year, which is 1.25 million, and the costs are incurred 1 million, so 250,000 will be the profit reported in the second year. Now here we are having the same example with the modification that in year 2 the job is completed incurring a total cost of 1.25 million rather than 1 million. In this case, the revenue and cost reported in the first year will remain the same, that is 3.75 million in revenue and 3 million in cost, that is 750,000 in profit. However, the year 2 revenue will be the same, but the cost will also be 1.25 million, which will make the second year reported profit equal to 0. Now this shows the importance of estimates. If the company underestimates the cost, it will have effect on revenue and profitability over time. The advantage of the percentage of completion method is that it results in better matching of revenue with accounting period in which it was earned. The percentage of completion method is the preferred method of revenue recognition for long-term contracts and is required when the outcome can be measured reliably under both IFRS and US GAAP. Under both IFRS and the US GAAP, if a loss is expected on the contract, the loss is reported immediately, not upon completion of the contract, regardless of the method used, that is percentage of completion or completed contract. Under the IFRS, if the outcome of the contract cannot be measured reliably, then revenue may be recognized to the extent of the contract cost incurred, but only if it is probable that the cost will be recovered. In such a case, costs are expensed in the period they are incurred. Under this method, no profit is recognized until all the cost had been recovered. So from our previous example, in the first year, the company will recognize revenue of only 3 million, which is exactly equal to the cost for that year. So there will be no profit reported in the first year. In year 2, the company will report revenue worth 2 million and the cost will be 1 million, and hence all the profit will be reported and recorded in the second year, that is equal to $1 million. Under the US GAAP, but not under the IFRS, a revenue recognition method used when the outcome cannot be measured reliably is the completed contract method. Under the completed contract method, the company does not report any income until the contract is substantially finished. The remaining cost and potential risks are insignificant in amount, although provisions should be made for expected losses no matter revenue is not reported. From our example, we can see that under the completed contract method, the company will not report any revenues here and will neither expense the cost, but they will be reported as assets on the balance sheet. And in the second year, when the contract is completed, all the revenues and cost will be recorded here. So this is going to be recognized as revenue in the second year, and then the costs that have been accumulated as an asset in the balance sheet will be reported as expense, and then the profit will be the same 1 million. Under the US GAAP, the completed contract method is also acceptable when the entity has primarily short-term contract. Also note that if a contract is started and completed in the same accounting period, there is no difference between the percentage of completion and completed contract methods in terms of revenue recognition and expensing the costs. Let's have an example where the outcome of the long-term contract are not reliably measurable. So here we have a company that has a contract to build a network for a customer for a total sales price of $10 million. The network will take an estimated 3 years to build. There is considerable uncertainty surrounding the total building cost because new technologies are involved in the construction. The outcome cannot be reliably measured, but it is probable that the cost up to the agreed upon price will be recovered. Expenditures total $3 million, $5.4 million, and $6 million as of the end of year 1, 2, and 3 respectively. The question is, how much revenue, expense, that is cost of construction, and income would the company recognize each year under IFRS and using the completed contract method under the US GAAP? Using IFRS, we will recognize revenue equal to the annual cost in the first 2 years, and in the final year, the revenue will exceed the total cost because we will be recognizing income then. So in year 1, the total revenue will be equal to the exact cost, that is 3 million. So profit will be equal to 0. In year 2, the net income will be again 0 as we will be reporting revenue equal to 2.4 million, which will be exactly equal to the total cost for that year. In year 3, we will be reporting $4 million in net income because this year now we are going to have only 0.6 million in cost and 4.6 million in revenue, and that will be the case because we are now recognizing total income of the project in the final year when it is completed. Under the US GAAP, we will be using the completed contract method as the outcome of the project are not reliably measurable. So there will be no construction cost recorded in the first 2 years and there will be no revenue recorded also in the first 2 years. All costs incurred will be capitalized and reported in the balance sheet. In the third year, all the construction cost will be expensed and all the revenue of the project will be recorded. So we see that in the first year, there will be no revenue reported and no cost reported in the income statement, so no net income. In the second year, again, no revenue, no cost reported in the income statement. And in the third year, we will have all the revenue recognized and then all the cost expensed. So we will be left with the same 4 million in net income. We know that revenue is normally reported when goods are delivered or services are rendered, independent of the period in which cash payment for those goods or services are received. This principle applies even to installment sales. Installment sales are those in which the proceeds are to be paid in installments over an extended period of time. For installment sales, IFRS separates the installments into the sales price, which is the discounted present value of the installment payments, and an interest component. Revenue attributable to the sales price is recognized at the date of the sale, and revenue attributable to the interest component is recognized over time. The International Financial Reporting Standards note, however, that the guidance for revenue recognition must be considered in light of local laws regarding the sale of goods in a particular country. Under limited circumstances, recognition of revenue or profit may be required to be deferred for some installment sales. An example of such deferral arises for certain sales of real estate on an installment basis. Revenue recognition for sale of real estate varies depending on specific aspects of the sale transaction. Under US GAAP, when the seller has completed the significant activities in the earning process, a sale of real estate is reported at the time of sale using the normal revenue recognition conditions, provided either the seller is assured of collecting the selling price or is able to estimate the amounts that will not be collected. Otherwise, when those two conditions are not fully met, some of the profit is deferred under US GAAP. Two methods that may be appropriate in these limited circumstances and relate to the amount of profit to be recognized each year from the transaction are the installment method and the cost recovery method. Under the installment method, the portion of the total profit of the sale that is recognized in each period is determined by the percentage of the total sales price for which the seller has received cash from the buyer. Under the cost recovery method, the seller will not report any profit unless the cash amounts paid by the buyer, including principal and interest on any financing from the seller, are greater than all the seller's cost of the property. Note that the cost recovery method is similar to the revenue recognition method under International Financial Reporting Standards described earlier, when the outcome of a contract cannot be measured reliably, although the term cost recovery method is not used in the international standard. Here we have an example. Suppose the sales price and cost of a property are $2 million and $1.1 million respectively. So the total profit from this is $900,000. The seller receives a down payment of $300,000 in cash, with the remainder of the sales price to be received over a 10-year period. There is significant doubt about the ability and commitment of the buyer to complete all the payments. How much the profit will be recognized attributable to the down payment if the installment method is used or the cost recovery method is used. As we know, the installment method will apportion the cash received from the buyer as down payment between the cost recovered and the profit using the ratio of the profit to sales value. In our case, the profit we determined on the previous slide was 900,000. So 900,000 was the profit and the sales were 2 million. So that means that the profit to sales ratio is 45%. So the down payment received is $300,000 in cash. So 45% of this, that is 135,000, will be reported as profit. Under the cost recovery method, we will not be reporting any profit unless the cash received from the buyer is more than the total cost of the sale to the seller. In this case, the cash received is $300,000 and the cost of the seller is $1.1 million. So the seller will recognize zero as profit attributable to the down payment from this sale. Another revenue recognition issue that became particularly important with the emergence of e-commerce is the issue of gross versus net reporting. Merchandising companies typically sell products that they purchase from a supplier. In accounting for the sales, the company record the amount of the sale proceed as sales revenue and the cost of the products as the cost of goods sold. As internet-based merchandising companies have developed, many companies sell products that they never hold in inventory. They simply arrange for the supplier to ship the products directly to the end customer. In effect, many such companies are agents of the supplier company, and the net difference between their sales proceed and their cost is their sales commission. What amount should these companies record as their revenues? The gross amount of sales proceeds received from their customers, or the net difference between the sale proceeds and their cost? Under the US GAAP, the approach should be based on the specific situation, and guidance for determining when revenue should be reported gross versus net is provided. So revenue should be reported as gross if the company is the primary obligor under the contract, bears the inventory risk and credit risk, can choose its supplier, and has reasonable latitude to establish the price of the product. Otherwise, the revenue should be reported as net. Here we have an example. Company OLR is an online retailer that buys tickets and resells them for $100 and earns a 10% fee. So what is the correct accounting? So alternative A is to report the revenues as gross. So revenue reported is $100, the cost of goods sold is $90, and the gross profit is $10. Alternative B is to report the $10 fee as revenue. Now, why should it matter? If the company does not bear inventory risk and does not have responsibility after, it should report it as net. However, this decision does not affect the net income reported in both the cases. Reporting revenues as gross or net is important, particularly for some internet companies that are valued using the price to sales ratio. So reporting revenue as gross or net will affect the multiple used in their valuation. Here is an example of the same principle that we just learned from Amazon's financial statement for the year 2011, and the company is stating in this disclosure that whenever it has the obligation, it reports the revenue as gross. Otherwise, it reports it as net. To analyze a company's financial statements and particularly to compare it against other companies, it is helpful for an analyst to understand the differences in revenue recognition policies. Although it may not be possible to calculate the monetary effect of differences between particular companies' revenue recognition policies and estimates, it is generally possible to characterize the relative conservatism of a company's policies and to qualitatively assess how differences in policies might affect financial ratios. Expenses are defined as the decreases in economic benefits during the accounting period in the form of outflows or deflation of assets or incurrences of liabilities that result in decreases in equity other than those relating to distribution to equity participants. Under the IFRS, the term expenses includes losses as well as those expenses that arise in the course of the ordinary activities of the enterprise. Under the US GAAP, expenses are defined as the outflows or other using up of assets or incurrences of liabilities, or a combination of both, from delivering or producing goods, rendering services, or carrying out other activities that constitute the entity's ongoing major or central operations. Under the US GAAP, however, expenses do not include losses. Losses are defined under US GAAP as decreases in equity or net assets from peripheral or incidental transactions of an entity and from all other transactions and other events and circumstances affecting the entity except those that result from expenses or distribution to owners. Generally, a company recognizes expenses in the period that it consumes or uses up the economic benefits associated with the expenditure or loses some previously recognized economic benefit. This is consistent with the matching principle. Period costs are, on the other hand, expenditures that less directly match revenues in the same period. They are reflected in the period when a company makes the expenditure or incurs the liability to pay. Administrative expenses are an example of period cost. Other expenditures create assets that will result in future benefits over a number of accounting periods. For example, building, equipment, prepaid rent, etc. In this case, the expenditures are allocated systematically with the passage of time. An example of this is the depreciation expense for long-term fixed assets. Here we illustrate the cost flow of inventory for a company that purchases inventory items for resale as a wholesaler or as a retailer. During the period, the company purchases goods which are added to its beginning inventory. Beginning inventory plus purchases equals the cost of goods available for sale. As the goods are sold and revenues are recognized, the cost of goods sold will be removed from the inventory and recorded as an expense. Any item not sold during the period remain in the ending inventory. The ending inventory, as we know, is reported in the balance sheet, and the cost of goods sold, that is the inventory sold during the period, is reported as an expense in the income statement. To illustrate the cost flow for inventory, here we have an example. In the first quarter, 2000 units are purchased at $40 per unit. In the second quarter, 1500 units are purchased at $41 per unit. In the third quarter, 2200 units are purchased at $43 per unit. In the fourth quarter, 1900 units are purchased at $45 per unit. Total units purchased during the 4 quarters is 7,600, and the total cost of these units is $321,600. The inventory sales during the year are 5,600 units, and the sales price is $50 per unit. What are the revenue and expense for these transactions during the year? Assume the company specifically identifies that the 5,600 units sold were those purchased in the first and second quarter plus 2,100 units purchased in the third quarter, and the 2,000 remaining units were 100 of the purchased units in the third quarter plus the 1900 purchased in the fourth quarter. As the company has specifically identified the units that were sold and the units that are left in the inventory, here we see that the cost of goods sold is equal to the cost of the 2000 units that were purchased in the first quarter at 40 per unit, the 1500 units that were purchased at $41 per unit in the second quarter, and the 2100 units purchased at $43 in the third quarter. The total cost of these is equal to $231,800. The ending inventory is then comprising of the 100 units from the third quarter at $43 per unit and the 1900 units that were purchased last in the fourth quarter at $45 per unit. So the total ending inventory is 89,800. During the period, the number of units available multiplied by their respective cost per unit, if we total that, that is including the cost of goods sold plus the ending inventory, we get the total available for sale, that is the goods available for sale during the year. The revenue for this period was 5,600 units at $50 per unit, that is 280,000. In this example, we continue with the same data that we have on inventory and sales. However, this time to recognize revenue and expense, we are assuming that the company does not specifically identify the units, but instead is using the weighted average cost method of inventory costing. To calculate the total cost of goods sold, we have to calculate the weighted cost per unit of inventory. So we know that the total cost of the inventory, that is 7,600 units, is equal to $321,600. So we divide this by the number of units that we have purchased in the 4 quarters, and this gives us the per unit cost of $42.3158 per unit. During the year, we sold 5600 units, so the cost of sales will be equal to 5600 units at $42.3158 per unit. That gives us the total cost of sales of $236,968. In the ending inventory, we have 2000 units left because the total number of units are 7600, out of which we have sold 5600 units, so we are left with 2000 units, and the per unit weighted cost is 42.3158. Multiplying this by the remaining number of units, we get the cost of ending inventory, which is $84,632. The total revenue remains the same, that is 5600 units at $50 each. In the third scenario, we have the same data as we have used in the previous 2 cases. However, this time we are not assuming to use the specific identification method or the weighted average cost method, but the FIFO method, that is the first in first out method of inventory costing. In this method, as we know, units that have been purchased first will be sold first or will be taken out of inventory first. So we will be left with the latest purchased units, that is 1900 units from the 4th quarter and 100 units from the 3rd quarter. The cost of goods sold in this case is equal to $231,800, which is equal to the cost of the 2000 units from the 1st quarter at $40 per unit, 1500 units from the 2nd quarter at $41 per unit, and 2100 units from the 3rd quarter at $43 per unit. This is exactly the same as we obtained from the specific identification method. Also, our inventory at the end will be the same as the one we obtained from the specific identification method. The reason being that the specific identification method revealed the same units were sold and left in inventory as we have from the FIFO. It will always be not the case, but here it is. In the 4th and final scenario, we have the same data set. However, this time we are going to use the LIFO method of inventory costing, and we know that LIFO is only allowed under US GAAP but not under IFRS. Under the LIFO method, units that are purchased the last are assumed to be sold the first. So we have the 5600 units calculated as the 1900 units in the 4th quarter at $45 per unit, 2200 units in the 3rd quarter at $43 per unit, and the 1500 units that were purchased in the 2nd quarter at $41 per unit. So we are left with the 2000 units in the 1st quarter at $40 per unit. The total cost of goods sold of these 3 quarters units is $241,600, and the cost of the inventory is equal to the 2000 units from the 1st quarter, which is exactly equal to 80,000. These 4 scenarios are summarized here. So we see the sales in all the 4 methods is the same. However, the cost of goods sold varies from one method to the other, except for the specific identification method, which has the same numbers as the FIFO because it assumes the same flow of cost and inventory as the FIFO method. And we also see that profitability varies because the cost of goods sold varies from one method to the other. And this also has an effect on the inventory reported on the balance sheet. So we see that the specific cost flow assumption, that is whether the company chooses the specific identification method or the weighted average cost method or the FIFO or the LIFO, has an effect on the financial performance as well as the financial position of the company. The impact of cost flow assumption for inventory are summarized here for the 3 methods, and we see that when prices are rising, the cost of goods sold reported by the FIFO method will be the lowest, while the LIFO method will report the highest cost of goods sold. The average method will report a cost of goods sold that will be in the middle of the FIFO and the LIFO method reported figures. Similarly, inventory will be the highest when prices are rising under the FIFO method, and it will be the lowest under the LIFO method. And again, the average method will show the inventory to be within the LIFO and FIFO figures. The next expense recognition application we have is of depreciation. Companies commonly incur costs to obtain long-lived assets. Long-lived assets are those that are expected to provide economic benefits over a future period of time that is greater than 1 year. Examples are land, plant and equipment, and intangible assets such as goodwill, trademark. The cost of most long-lived assets are allocated over the period of time during which they provide economic benefit. The two main types of long-lived assets whose costs are not allocated over time are land and those intangible assets with indefinite useful lives. Depreciation is the process of systematically allocating cost of long-lived asset over the period during which the assets are expected to provide economic benefits. Depreciation is commonly used to refer to the systematic allocation of the cost of tangible, physical, long-lived assets. On the other hand, amortization is the term applied to this process for intangible, long-lived assets with a finite useful life. Example of intangible, long-lived assets with a finite useful life include an acquired mailing list, an acquired patent with a set expiration date, and an acquired copyright with a set legal life. Intangible assets with indefinite life are not amortized. Instead, they are reviewed each period as to the reasonableness of continuing to assume an indefinite useful life and are tested at least annually for impairment. If the recoverable or fair value of an intangible asset is materially lower than its value in the company books, the value of the asset is considered to be impaired and its value must be decreased. The method used to compute the depreciation should reflect the pattern over which the economic benefits of the assets are expected to be consumed. The most commonly used depreciation method include the straight line method, the accelerated depreciation method, and the units of production method. In the straight line depreciation method, it is assumed that the economic benefits are received equally across the useful life of the asset. Under the accelerated method, it is assumed that the asset's economic benefits are extensively received in the first year and then subsequently decline over time. The units of production method assumes depreciation in terms of the units produced out of the plant or the machinery. So the greater is the number of units produced, the greater is the amount of depreciation. Here we have equipment that costs $9,000 with zero salvage value or residual value and useful life of 3 years. The annual depreciation expense will be cost minus residual value divided by useful life. So that will give us 3,000, 9,000 minus 0 divided by 3. So the cost of equipment in the first year is 9,000 and the first year depreciation is 3,000. So the book value at the end of the year is 6,000. At the end of the second year there is depreciation of 3,000. So the book value at the end of the second year is 3,000. And finally, the third year depreciation will reduce the book value to 0. Judgments and estimates are needed in depreciation. These include the estimate of salvage value at the end and estimate of the useful life. For example, an asset has a purchase price of $10,000. What is the annual straight line depreciation expense if the estimated salvage value is $5,000 and the useful life is 10 years? Or if the estimated salvage value is 0 and the useful life is 2 years. So we can see here in the first case, the depreciation amount is equal to 10,000 minus the residual value of 5,000 divided by 10 years. So that gives us $500. In the second case, when the salvage value is 0, we will have 10,000 minus 0 divided by the useful life of 2 years, which gives us 5,000. So we see that the amount reported as depreciation is quite sensitive to the assumptions made regarding the salvage value and the useful life. The alternative to the straight line depreciation method is the accelerated method, and the most common one is the diminishing balance depreciation. To use diminishing balance method, first determine the straight line rate, which is equal to the value of the asset divided by its useful life. In the second step, determine the acceleration factor, for example 1.5 times or 2 times. In the third step, calculate the depreciation rate, which will be equal to the straight line rate from step 1 multiplied into the acceleration factor chosen in step 2. And then to calculate the depreciation expense, you multiply the depreciation rate by the net book value, and that gives you the annual depreciation each year. Then we continue doing the same over the life of the asset till we reach the point where the net book value of the asset is equal to the salvage value. Now here we have an example where the asset will cost $11,000 with an estimated salvage value of $1,000, estimated useful life of 5 years, and acceleration factor of 2 times. So first we calculate the straight line depreciation rate, which is equal to 11,000 minus the 1,000 salvage value divided by the useful life, which is 5 years, and that gives us 20%. Now we are told that the acceleration factor is 2 times of the straight line rate. So the depreciation rate applicable will be 20% multiplied into 2, that is 40% is the accelerated rate that we are going to use. So in the first year, the depreciation will be equal to the 11,000 value of the asset multiplied into 40%, that is $4,400. The complete schedule of depreciation for our example is shown here, where depreciation expense each year for the first 4 years is exactly 4% of the net book value of the last year. However, in the 5th year we see that depreciation expenses are only 426. That is the balancing amount, because we cannot depreciate the asset beyond $10,000. So we see that this is the amount that we get by deducting 9,574 from 10,000, which is the total depreciable value of the asset, and we are left with 1,000, which is the salvage value we used in calculating the depreciation rate. In the next tutorial, we learn about EPS, how to calculate it and how to use it in investment analysis, and then subsequently we learn how to analyze income statement.